All right, let's talk about investing. You ever look at the stock market and just think, where do I even start? It feels like you have to be some kind of genius to pick the next big winning company, right? Well, what if I told you there's a way to skip all that guesswork? That's where this amazing tool comes in, the Exchange Traded Fund, or ETF. Let's dive in and figure out what these things are all about. So let's just get right to it. The big question is this. How on earth can you invest in an entire market with just a single purchase? I mean, buying a piece of, say, the top 100 companies all at once with just one click? It sounds kind of impossible, right? Like it should be super complicated. But the answer? Well, it's actually pretty brilliant in its simplicity. And that answer, you guessed it, is VETF. The name, Exchange Traded Fund, pretty much tells you everything you need to know. First, it's a fund, which just means it's a big collection of different investments. And second, it's traded on an exchange, just like a regular stock. So the bottom line is, instead of buying a piece of just one company, you're buying a tiny piece of a fund that owns hundreds or even thousands of them. Okay, so that's the what. But how does it actually work? To really get a handle on this, let's use a super simple analogy. Think of it like a basket. Picture this, you're walking into a grocery store. Now, you could go down every single aisle picking out one apple, then one banana, then an orange. You get the idea. It takes time, right? Or you could just grab one of those pre-made fruit baskets right at the front. It's got a little bit of everything already in there. Well, an ETF is exactly like that fruit basket. It's pre-packaged with all sorts of different investments, and you get to buy that whole basket in one go. Let's break down the actual process here. So, step one, somebody creates what's called an index. Think of it like a list. Maybe it's a list of the 100 largest tech companies. Step two, an investment company comes along and creates an ETF that is designed to perfectly copy that list. It literally buys all the stocks from that index in the same proportions. Then, step three, you come along and buy just one single share of that ETF on the stock exchange. And boom, step four, just like that, your single investment now automatically tracks the performance of that entire group of 100 companies. It's a really simple idea, but it's incredibly powerful. Now, this leads to a really important question that a lot of people have. They think, okay, I get it, but isn't this just like buying any other stock? And the answer is, well, not really. Let's put them side by side and see what the real difference is. So here's the absolute key difference. Buying a single stock? That's like placing a bet on one single tree in a massive forest. If that tree gets sick or falls over, well, your bet is in trouble. All your risk is in one spot. But buying an ETF? That's like betting on the health of the entire forest. You're basically investing in the average of everything. So yeah, one tree might have a bad season, but the other 99 trees around it are probably doing just fine, and that balances everything out. Okay, so we keep talking about these baskets filled with assets, but what kind of stuff are we actually talking about here? What can you find inside an ETF? You might be surprised by just how much variety there is. ETFs can hold, well, pretty much anything you can think of. The most common ones, for sure, hold stocks from hundreds of different companies. But they can also hold things like government bonds or corporate bonds. You can get ETFs that focus only on specific industries, like technology or healthcare. There are even ETFs that hold commodities. We're talking about things like gold, silver, or even oil and agriculture. The possibilities are just massive. It's a whole universe of options out there. So when you look at all this, what's the big idea? If you had to boil the entire reason ETFs exist down to just one phrase, it would be this: diversification with simplicity. That's the whole game. The goal is to spread your investment risk across tons of different things, but do it in the easiest, most straightforward way imaginable. One click and you're diversified. Okay, but let's be real for a second. No investment strategy is perfect, right? There are always two sides to the coin. So to get the full picture, we really need to look at both the good and the not so good. Let's break down the pros and cons. All right, let's start with the good stuff. First, you get that immediate diversification we've been talking about. That's a huge win. Second, they're super easy to buy and sell, just like a stock, anytime the market is open. Third, they're really transparent. You can literally look up exactly what's inside the fund at any time. And here's a big one: the costs. They are almost always cheaper, sometimes way cheaper than old school mutual funds. This makes them amazing for anyone who wants to just buy something and hold it for the long term. But, of course, there are trade-offs. For one, an ETF is designed to match the market, not beat it. So you're never going to get those crazy outsized returns. And that also means when the whole market goes down, guess what? Your ETF is going right down with it. There's no escaping a downturn. Also, some of the really weird, specific ETFs can have what's called low liquidity, which just means not many people are trading them, so it might be a little harder to sell. And finally, sometimes there's a tiny tracking error where the ETF doesn't perfectly match the index it's following. It's usually small, but it's something to know. And that point about not trying to beat the market brings us back to why they're so cheap. Most ETFs use a strategy called passive management. This means there isn't some high-paid manager in a fancy office trying to outsmart everyone and pick the next big stock. Nope, the fund just copies the index. It's a robot's job, really. It just replicates the list. Because it's so automated, it costs way less to run, and those savings get passed right on to you. So we've covered a lot. We know how they work, what's inside them, the good, the bad, which brings us to the final and maybe the most important question. Is an ETF actually right for you? Well, from everything we've seen, ETFs are often a really, really good fit for a few kinds of investors. For beginners, absolutely. They're probably one of the simplest ways to get started. For people who are in it for the long haul, the buy and hold crowd, perfect. And for anyone who gets nervous about putting all their eggs in one basket with single stocks and just wants that broad, predictable market exposure, they are a fantastic choice. So we'll leave you with this final thought. You now know the secret. An ETF is basically a simple, low-cost way to buy the whole market in one shot. It's an incredibly powerful concept. So the real question to ask yourself is, now that you know what it is, how could a tool like this make your investment journey a whole lot simpler? Something to think about. Thanks for tuning in.